Good morning, everyone. Welcome back to Blue League Markets. Welcome back to our channel. On this video, I just want to make a short video explaining the importance of imbalances or fair value gap, as others may call it. Um, Before I do that, though, I just want to explain something for those who want to join our group. I'm going to leave a link on the description of this video. It's a WhatsApp group link. Please join that WhatsApp group. Then when you get there, please go and check who the admins are. There's only two admins, which is the founders and mentors for Blue League. You can text one of the mentors and tell them you want to join the paid mentorship for those who've been asking about the paid mentorship. So our paid mentorship is divided into two. We have a 3 month mentorship where we mentor you for 3 months, teach you everything we know until you fully understand how to trade like us. Then the second one is a lifetime mentorship where we teach you how to trade for a minimum of 3 months. Then we help you in your trading journey until you fully understand how to trade and how to understand everything. Then we also have the third option. The third option is for you to purchase our modules. We have two modules. We have smart money and we have advanced smart money. So we'll just send you our material. Then after that, you will learn on your own, and we'll give you all the links to the private groups, not the private groups, the private videos, and you'll be able to learn. We accept students from any part of the world. Currently, we have students in the US, students in London, students in Nigeria, South Africa, Botswana. So we welcome everyone, and we want to create um, a trading community where we assist each other with trading whenever you don't understand something. Our paid mentorship, we only do mentorship on one-on-one basis, meaning if you pay, we will have a one-on-one class so that we can meet individual needs. We don't want a situation where we mix everyone into one group while we're explaining certain things, then others don't understand. Because what we have realized about trading doesn't really have a specific strategy. We just teach approaches. Others call it a strategy, we call it an approach to the market. And after teaching you an approach to the market, you'll be able to develop your own strategy and your own understanding based on whatever we're going to teach you, and come up with a way which you are comfortable to make money in the market. Um, Without wasting any time, because I don't want this video to be long, I just wanted to make a short video explaining imbalances. So we trade in US 100, which is Nasdaq. We on 4 hour. Oh, before I forget, guys, I see a lot of you are coming to our channel and they're watching our videos without subscribing. Guys, in order for us to keep making more videos, please do subscribe to our channel, share our channel, then also like our videos, comment, engage with us in the comment section so we can know that you understand or you don't understand certain things. Now, on this video, I just want to highlight few things. Imbalances. So imbalances are very important, and they work with order blocks. I just want to explain something. Imbalances occur in three candles, or they occur when you have a first candle, then the second candle. Usually, the second candle becomes an engulfing candle. It becomes big. Then you have the third candle, right? So imbalance occurs between the two candles, as you may see, right? So we have candle A, we have candle B, and candle C, right? Now, let me just name this A. So we have candle A. Let me just get rid of that. So we have candle A. You always need three candles when you want to check if you have a good imbalance of every. then you have candle B, and then lastly you have candle C. So every time you're dealing with imbalances, please consider three candles. Then you have candle C there, right? So how do you check an imbalance? So your imbalance, you focus on candle A and candle C, right? So you'll check the wick for candle A and you'll check the wick for candle C. If the wick for candle A and candle C do not overlap, for example, if I do it this way, that means this week and this week have overlapped. That means you have no imbalance. That means the market has balanced itself around here in the overlap. There's no imbalance there, right? But in a case where candle A and candle C do not overlap, sorry, let me get rid of that. In a situation where candle A and candle C have not overlapped, that means you have no imbalance. For example, if candle C's opening wick is there, that means you have imbalance between candle A and candle C, right? That means the imbalance will start there and it will end there, right? That means the market has to come back to this fair value gap or this imbalance and it needs to fill the market out. That means the market had a huge push and orders were left there, right? So the high probability is you'll see the market going up and eventually going down to this to this fair value gap and it will close in the orders there. So that's the explanation for um fair value gap or imbalance. I think I've explained this in certain videos. Please go check our other videos. We have about 18 videos in our channel. Check those videos, you'll get a better explanation of imbalance. I just didn't want to explain a lot about it here because I want to explain how you can actually use it as an approach to take trades. Well, depending on how you go about it, you need to combine it with a lot of things. But here I'm just going to explain the beauty of imbalances, right? So let's begin. Excuse me, I have a bit of flu. That's why my voice is like this today. But anyway, let's name this candle. So this first candle, this one, becomes our candle A. Let me delete that. So that becomes our candle A. This is our candle B. This is our candle C. As I told you that you go firstly the wick of candle A, then number two you go and approach the and draw a line on the wick of candle C, right? So let me zoom that so everyone sees. And this is a 4-hour chart, guys. Remember. So as you can see that I've taken the wick of candle A. This is candle A. This is candle A. I've taken the wick of candle C. So like I told you that you need three candles. This is candle 1, 2, 3, candle A, B, C, and this is the fair value gap. Now you understand why the market came and touched there and went up, right? If you take a Fibonacci retracement, let's just see where the market retraced, right? I don't use all the Fib tools. I only use one, 0.5 and 0. So it's my 50%, 0% and 100%. As you can see, the market yes, let me just correct that so it can be perfect. Yeah, as you can see that the market came and perfectly touched your 50% zone, so it balanced itself out. So if you wanted to trade this, you could have easily taken a buy below your 50% zone or at your 50% zone. As you can see that this trade played out perfectly. The market came exactly at your 50% zone, so you could have taken a buy there and you put your stop loss just below where your fair value gap ends. And where do you target? You target the highest point before the market started retracing or going back down. So you could have taken a buy there. And remember, guys, this is a 4 hour chart, meaning this trade could have played out after how many hours? So we have 4, 8, 12, 16. So it could have played out over more than 20 hours, right? So this was a nice trade. That's how you trade fair value gaps or imbalances, right? So that zone now becomes an important zone. I wouldn't be surprised if I see the market coming back to this zone again to retest it, or break it, then retest it afterwards. That's what some of the people think support and resistance is. It's not really support and resistance, it's just the market balancing itself out. That's where you get your fair value gaps. I don't trade support and resistance, that's just liquidity. I'm just making an example, right? On how certain people think certain things play out, but in true accents, it's just fair value gaps. Now, let's continue and look for other fair value gaps. As you can see here, we have another candle, we have this candle, and this candle. So we'll just highlight the wick of this candle, highlight the wick of candle C, then we're going to highlight it. So I wouldn't be surprised if the market comes back to retest that zone there. It doesn't necessarily mean that if the market didn't come and retest that zone, it won't come back. It can still come back. Don't be shocked when the market comes and retests this zone and be confused why the market retested that zone. It's because of the fair value gap. Let's go look for other fair value gaps. Now, this is the most important things. This is why I did this video. If I would ask you here, which one is your fair value gap? A lot of people would say that um, the fair value gap starts here and ends there, which is correct. Yes, this is what I wanted to say. So the fair value gap is between this candle, that candle, that candle. Now, but then if we had to combine fair value gaps with our order blocks, our order block in this case is not this, because someone would say that this is our last candle before the push up. So this is our last sell candle before the buy. Guys, this is not our order block, right? Our order block, it's actually this whole candle. Why am I saying that? Because this candle, the low of that candle was broken by the low of this candle, right? As you guys can see here, that this low was broken by this low, right? So now our new order block becomes this whole candle from there to there, right? So now the power of this is that the reason the market didn't come to retest a 50% of our fair value gap. Remember, guys, this is our fair value gap, this is our order block. The reason the market didn't come to 50% is because it was respecting our order block. It was not respecting our fair value gap. So sometimes you might have a order block inside the fair value gap. Let's say, for example, we had an order block here. The market was going to come and retest that order block. Now, because our order block is above the fair value gap, that's why the market just touched our order block um and went up, right? So some of the people could have taken a trade here on the 50%. Sorry, they could have taken a trade on the 50% and the trade was not going to play out, and they would say that we teaching fake things. We're not teaching fake things. You just have to understand that in this case we had two things going on, right? So the most important thing is what the market makers took. So we had this big order block, right? Number one. Number two, we had a fair value gap inside, right? So what did the market respect? The market respected our order block. So it was safe to take a trade. You could have taken a trade on the opening of the order block, or you could have taken a trade on the opening of your fair value gap. Because now the market had two things to mitigate: your order block and your fair value gap. Which one takes first preference? It's your order block, right? what do you target? In this case, you target the highest point before the market came out. Now remember guys, this is a 4-hour chart, meaning this trade could have worked out after a lot of days. So and you could have made a lot of money there. And your drawdown was, you could have had the lowest drawdown ever. So if you had a 5,000 rent account, for example, if you're in South Africa, your drawdown could have been less than 1,000, and you could have made something close to 25,000 to 50,000, because these are a lot of candles and it's a 4-hour chart, right? So you should understand fair value gaps, and you should understand that you can combine them with order blocks and you can take trades easily, guys. So that's what I wanted to teach on this video. I don't want to make it long. I teach this thing on our paid mentorship. So if you want to learn more about it, you can go to our paid mentorship. As you can see that it also played out here. So we have this candle, then um we have this candle. So we have the fair value gap between uh this candle and this candle, right? So this is our whole fair value gap, right? But as we can see that before this fair value gap or this imbalance, we had an order block, right? So this is our order block. And remember, what did I say? I said the market always give first preference to our order block. That's why the market went and filled the fair value gap or the imbalance and actually took orders on our order block. So our order block, it's important. It takes first preference. Let's just check. It came perfectly on your 50%. So you could have taken that trade easily, and you get confirmation on your lower time frame, right? So you could have taken that trade easily using confirmation on our lower time frame, right? So that could have been a buy. You target your highest point before the market went down. Then what do you do for your stop loss? You take your stop loss there, right? So this is easy stuff. Nasdaq always respects this. If you combine this with your smart money concept, your liquidity being taken out, your inducement, you combine it with your break of structure, your change of structure, you combine it with a whole lot of things, you can have a powerful approach to the market, and you'll be able to make money in the market. Guys, let me stop this video here. Don't forget to go on the link below, check out our WhatsApp, go talk to one of the mentors, tell them what you want to do. Either you want to join the paid mentorship, the 3 months paid mentorship, or you want to join the lifetime mentorship, or you want to purchase, excuse me, our material. Then we'll tell you the prices and we'll send you the details on how you can join. Please don't forget to share this video, like our previous videos, watch them. You'll get a lot of free stuff on our YouTube channel. This is Blue League Market signing out. Thank you for watching.